Fixed coupon structure notes for Australian wholesale clients only. What are fixed coupon structure notes? They are a debt obligation of the issuer with embedded derivatives such as options, warrants, and futures. The notes take exposure to a selected asset class, which can be a single or a basket of stocks, indices, ETFs, commodities, or a combination of different assets. Key features. The notes pay an unconditional fixed coupon on a regular basis, regardless of movement of the underlying assets, whether they move up, down, or sideways. The notes generally have a specified investment term of 3 months to 3 years. Some notes have an inbuilt auto-call feature that enable the note to be early redeemed when the preset condition is met. Now then, we'll take a look at a concrete example for illustrative purposes. Let's consider this AUD 24 months fixed coupon note linked to NAB, BHP, and Telstra, issued by a large global bank. This note pays an unconditional fixed coupon of 8.4% per annum, in other words, 0.7% flat per month. Its investment term is 24 months. This note has a monthly memory auto-call feature, which will be activated at the end of month 4. If there isn't any early redemptions, the note will redeem at maturity. Now, we'll consider 3 possible scenarios that will allow us to explore the various conditions upon receiving the frequent coupons. Scenario 1. Early redemption. Starting from the end of month 4, the monthly memory auto-call observation of the stock's price will start to take place. For this product, the auto-call condition is when all 3 underlines are at or above its 95% initial level, either independently or concurrently. We call this an early callback or an early redemption. After month 4, if a underlying from the basket is at or above its auto-call level, this will trigger the auto-call barrier. In this case, 2 stocks have already reached this level in month 4 and month 6. So, in month 12, this product is early redeemed, as the last stock has also gone past the 95% auto-call level. This will mean that the total payout for investors in this scenario will be 100% their original principal and a 0.7% monthly coupon for the whole investment year. Scenario 2. No early redemption plus no knock-in event. During the whole investment term, if there is no early redemptions nor knock-in events, the structure note is held to maturity, and the total payout will be calculated using the coupon rate and coupon frequency. Given that there is no early redemption because only 2 stocks are above its auto-call level, at maturity, all the 3 underlines, including all the previously memorized ones, will be assessed against the knock-in level. At the end of the investment term, if the price of the worst performing underlying among the basket of securities is above the knock-in level, that is 60% in this case, investors will receive 100% original principal plus all the 24 monthly coupons. Scenario 3. No early redemption plus knock-in event. A knock-in event is only observed at maturity, given that there wasn't any early redemptions. With this specific example, we have defined the knock-in level as 60% of the stock's initial level. Now, with only 2 of the 3 underlines reaching its auto-call level, we have no early redemptions here. With no early callbacks, all the 3 underlines will be assessed against the knock-in level at maturity. At the end of the investment term, should the worst performing underlying fall below 60% of its initial level, a knock-in event will occur, in which case the client will receive the final coupon. Regarding the total return, clients will have 2 options to choose from. They can either have physical delivery of the worst performing underlying, or if they would like it in cash, their total payout is calculated using the above formula. Note that both options include all the 24 periodic coupons. In summary, investors will get one of the three investment outcomes, and the total payout will vary accordingly, depending on investment situation. Finally, to sum up, let's analyze the benefits and risks of investing in fixed coupon notes. Benefits. Unconditional fixed coupon. Investors will get unconditional fixed coupon, regardless the underlying shares go up, down, or flat. Knock-in events at maturity only. Considering that a knock-in event is only assessed at maturity, the investment allows underlyings to drop up to the knock-in level, while clients will still get back the full principal. Early redemption. With the inbuilt auto-call feature, fixed coupon note may be early redeemed during investment term, and investors will get back the full capital when the auto-call conditions are met. Risks. Issuer risk. Investors are exposed to the credit risk of the issuer of structured notes. Least performing. Investors are exposed to the worst performing underlying in the basket at maturity. Potential loss. If the worst performing underlying closes below the knock-in level at maturity, investors will suffer a capital loss. In the worst scenario, investors can lose their entire capital. For any questions or more information, please email or call us directly.